Well, thank you all for joining us. This is our first webinar SoundSteers was doing for 2025. We're going to be talking through a little bit of discussion around investments. And so it will be, I'll host Jonathan Harrison. Jonathan's a lead advisor and partner at the firm. I'm a lead advisor at the firm. And so we're going to be working through some questions to think through and topics around investments and discovering the right way to invest in 2025. And as part of that, we are not giving any advice around one particular thing. Hey, buy into this, sell into that, sell that. None of that. This is not personal financial advice. This is just high level talking about the topic of investing and how we should go about that and think about that for 2025. So Jonathan, just thank you for taking some time out of your day to join us on this webinar. We're excited to get things started with you and hear what you have to say on some of these this topic here of investing.
Yeah, thanks, Derek. And I might stop sharing for a moment, come back to the slides in a second. But yeah, as you're thinking about like the right way to invest, even that is pretty interesting when you think about it, because like it's tough, back to your disclaimer, it's tough for us to know what the right way to invest is without knowing like who's the person investing and like what's the purpose of the money for. And but we certainly have some thoughts about some right ways of doing it.
Yeah.
So
Yep.
I thought it might be helpful as we're jumping in on investments to look back and say, okay, well, how did 2024 go? Before we start talking about 2025.
Yeah.
So what I'm going to share on the screen in a moment is what we call the asset chart. I'm sorry, the quilt chart.
Yes.
It lists a bunch of assets, but it looks like a quilt, which is why we call it that. And but to frame it up, each line, each column is a different year, and it ranks different types of investments in order of like the ones that did the best that year versus the one that did the worst. And then it shows the last 10 years. So I'm going to share that. Let me know when that pops up on your screen there.
Yeah, it looks great. Yep.
So, okay, so you can see 2024 off here on the right. The top thing for 2024, gold.
Yeah.
Gold did almost 27%. And but right behind that, so large cap, this is large US companies. This specific, the dark red box, it would be what people refer to as the S&P 500. If you've heard that term, it's an index of the largest, just a mix of the large top 500 largest US companies. And that's often when people say, hey, how'd the market do last year? A lot of times they're talking about this box. So last year you can see looks like a pretty good year. What's interesting about the quilt is it's best to worst, but it's some years, like for instance 2021, the best thing is at 40%, and in 2018 the best thing, which was cash, is at not even 2%. So it ranks them in order.
Yeah.
But it doesn't necessarily, they're not to the same scale, that's for sure. So I think it's interesting. It goes back. This is the 10th year that I've done this particular chart in a row. And when you look at it, some observations that come to mind for me are that there's not one clear winner that's the top every single year.
Right.
I know some people, the way they pick their 401k holdings is they just look at like, all right, what did the best last year? And that's not always going to do it, because something can be at the very top, like large cap had 3 good years, 2019, 2020, and 2021, but then was second from the bottom in 2022. So if you're just looking at it at a 1-year view, it's really hard to tell, okay, who's going to be the winner next year. And that's one of the things as we're talking about investing, and in 2025, like what's going to be the thing that knocks it out of the park in 2025? We can right up front say that I don't have any idea. Derek, what do you think?
My crystal ball is broken. I've been meaning to get that repaired, but I just haven't got around to it yet.
Yeah. Well, sometimes when I'm showing people this, I ask them, okay, out of those 10 years, what's the thing that you think did the best?
Yeah.
And it can be hard to tell, but I have the next slide actually shows to the right, I'm going to add the 10-year average for each of those investments.
Okay.
So if you were to average it out, the 10-year average, that S&P 500, that large cap, that averaged over 13% for those 10 years. And so you can see from that perspective, if you're taking a long-term approach and not looking at the ups and downs and the zigs and the zags every single year, then it's a very different, like for instance, commodities looked great in, maybe 2021, 2022, and then maybe again in 2024. But if you look at that 10-year investment, still hasn't even done 1%
Yeah.
average annual return. So knowing how something is doing long term is much more important than knowing how it did in just 1 year.
Yeah. Yeah. Jonathan, what would you say to someone who's, looking at this asset quilt and like, okay, well, in the 10-year average column, that's really helpful. Well, that's 10 years worth of data. Why don't I just do large caps and just disregard the others? It's like, what would you say to that?
Yeah, so like for instance, just invest in the S&P 500.
Yeah, it's like, hey, I'm just gonna buy the SP 500 and be done with it.
Yeah, so the one of the reasons that has come up a lot in this last year is because with the S&P doing almost 25%, most portfolios that are well diversified did somewhere in the range. Now, I mean, this is really broadly speaking.
Hmm.
Everybody's experience would have been very different, but it's not uncommon for a diversified portfolio to have done something like 7 to 9% last year. And when you're looking at that kind of return compared to like what the S&P 500 done, that gets back to your question of say, okay, well, why don't I just stick with the S&P 500? And I think the important thing to remember there is diversification.
Hmm.
And I want to come back to that because the S&P 500, so diversification means, not investing too much in one thing.
Hmm.
So in the sense that the S&P 500 is 500 things, it's 500 companies, that
Yeah.
does have some diversification,
Yeah.
but they're all large companies and they're all in the US. So when I'm talking about diversification, that means looking at, medium-sized companies, small-sized companies, international.
Yep.
So what's interesting is international, you can see over the last 10 years, really the last 15 years has not done as well as the US, like by far. Those large US companies have knocked it out of the park. Um, but if you look at longer time periods, there's often cyclical swings that go back and forth where the leadership can swing very easily.
Hmm.
Um, it's kind of like if you compare it to like real estate terms, um, the US large companies are kind of like the New York City, maybe real estate, where
Yeah.
it's been really hot. And
Yeah.
like if you own real estate there over the last 20 years, like did amazingly. And maybe the international and that analogy is more like Kansas City real estate, like did well, like you would have done well there too, but like the scale is not near as big that that you would expect some type of swing. And
Hmm.
so I think you should hold both international and S&P 500. Um, but I want to get back to that diversification in a little bit though too.
Yeah. Yeah. It's good.
That's a good question.
Yeah.
Um, in terms of the one of the problems with investing is if you're always chasing where returns were in the past, which is how a lot of people invest, you might miss where they'll go in the future.
Yeah.
So if you look at like valuations to say, okay, what are you getting when you buy something? Like um, the international stocks look much more better priced.
Yes.
You're getting more bang for your buck in a sense. However, as far as like how much money those companies are producing, but that doesn't guarantee that your investment returns are going to do better. But it would be really difficult. I think most analysts, commentators that I hear talk about say it'd be really difficult for those US large companies to keep performing like they have
Yep.
because they're so high priced right now. But That doesn't mean they can't. Anytime you're investing, you're setting expectations on the future.
Mm-hmm.
Like and one of the things we'll talk about, because Derek's crystal ball is broken, like we don't know the future.
All right.
And so everything you're putting a hypothesis to say, okay, what do you think is the most likely thing that's going to happen? And diversification says, okay, I don't exactly know what's going to happen, so I'm going to invest into a lot of different things.
Yep.
Um, does that make sense? Does that
Yeah.
answer that question a little bit?
Yeah, it does, and I know we'll talk more about you look at these different asset classes, but you can have problems inside these asset classes with concentration and whatnot, and we'll touch on that here in a little bit. But yeah, no, I like that, and it's always kind of looking back of okay, we talk about diversification a little bit here. Like, what does that mean for you and your household? How do you
Yeah.
apply that personally? Some people it does stop at S&P 500, others, and I would recommend that you look at it in a more broad sense, like we talked about just here.
Well, so maybe let's dig into that, because so this is looking back, thinking forward, like 2025 has some unique challenges. And one of them is that market valuation and that
Mhm.
concentration. And I do have a chart there to look at. I don't think, Derek, I haven't shown you this one yet. But this is back to, okay, what are you getting if you buy the S&P 500? If you buy an S&P 500 fund, um, what do you actually get? And mo most people, it's difficult to visualize that and can feel very like intangible. So this chart is
Ooh,
called a market heat map. This is all the 500 stocks in the S&P 500 that you get, and then the size represents how big the company is of each.
oh,
And this is from Schwab, and it's taken today, and the color basically represents performance. This is over the last 3 months. So one of the things that you notice when you first look at it is the Magnificent Seven. That's this big box in the corner. So it's these ones right here. That represents, depending on the day, roughly about a third of the S&P 500. So when you buy the S&P 500, you're getting a third of it is in just these seven companies. It's Apple, Nvidia, Amazon, Microsoft, Meta is Facebook, and Google and Tesla. So one of the things that's unique over the last few years is this is not near as diversified in the sense of, 33% of that is wrapped up into seven companies, which, by the way, when you look at that 25%, almost 25% return last year, is almost all in those seven. If you equalize the return, it was closer to 10%.
yeah,
And if you took out those seven, then it would even be a lot lower.
yeah,
So there is diversification because you're getting all 500, but you're not getting equal amounts of all 500. And in the next slide, so remember we had like large cap, mid cap, and small cap on that previous quilt chart. Small cap, that's actually so the S&P 500 is the one you hear about the most in the news, but there's actually an S&P 600. The next slide shows the S&P 600, and let me pull that up. And you can see how that's much more equally spread out. Like
hmm
there's not one particular company. I mean, there's a few that are a little bigger, but not near as concentrated in the top 10 as that other chart with the S&P 500. So the big concern is, what if these seven, which, Apple, Microsoft, Nvidia, like there's a reason that they're at the top, Google, they are, they're doing really well, but what happens if the law of large numbers catches up to them
yeah,
and they can't keep growing at the same rate? Or again, with investing, so much of it is expectations. What happens if, political or geopolitical or consumer sentiment just goes a different direction and knocks them off the rocker? Like that is going to hit that large cap area so
yeah,
much harder than if, one of the companies in one of these boxes struggles.
yeah.
So that's why I still think diversification is really, really important. We don't know when that swing is going to happen.
Right. Yeah, yeah. there's all these cycles that we are, versus domestic versus international, large versus small, like those all kind of roll in cycles there, and so that's where being truly diversified, like you kind of can protect yourself against trying to make a bet on where you're at in that cycle and where's it going to be and whatnot. And so,
Yeah.
um, yeah, we like to see that there.
And I was just looking at the difference between like large versus smaller companies,
Hmm.
but the same with US versus international, or even more developed markets versus more developing markets that are still, working to come online. So that's one concern I have is the market valuations and kind of the concentration
Yep.
in those top 7 companies
Yep.
make it easy to look like a really good investor
Yeah.
last year and even the last few years because bet on some horses that have been doing really well,
Hmm.
but could easily get tripped up. The other concerns as you think about 2025 is just the geopolitical and political tensions that we have. We don't know whether that's going to have a market, um, what kind of market impact that's going to have.
Yeah.
And
Yep.
if you were to go into past things and say, like the classic one we talk about is COVID, if you knew in January of 2020 all the things that were going to happen in that year, you would have said, well, I think the market's going to have a really, really bad year. And it ended out, very positively strong.
Right.
It was a wild ride to get there, but your crystal ball, most people's crystal ball, if they knew half, they wouldn't understand the results. They wouldn't have expected that.
Right.
So, and even if you think, Trump is good for this or bad for that, that doesn't necessarily mean that like the market will respond in the way that you expect.
Yeah.
And it's something that I would caution against. Um, Even if you like a particular policy or hate a policy, assuming that the market's going to respond in the same direction.
Yeah. Yeah, it is a challenge of you hear noise and you're like, okay, well that sounds serious, that sounds big.
Yeah,
Uh, how's that going to impact me? What do I need to do? And then you start looking at what are things I can control. Well, it could be clicking some buttons that make some trades in the portfolio or whatnot, but that tends to be not the right time to make those changes or whatnot.
yeah,
Of we like to say around here we plan the trade and then trade the plan, and so it's really about having a plan before we get into the thick of things. Before you're in the weeds and headlines are flying your way and life's happening and what do I do about this? It's like, okay, before we even got there, we've already talked about what we're going to do, and so then it's just reflecting back on that, and that's where like having someone in your corner to say, hey, remember you said this, whether
yeah,
it's a spouse, a friend, an advisor, but it's like, just remember, these were your words. We said we're going to do this when we got to this point. Now we're at this point. Don't back down. Either stay the course or here's the adjustment we said we were okay making. Because
yeah.
sometimes adjustments do need to happen as things change and either with career or life and or what or some people it's what their heart and stomach can handle was very different 10 years ago than it is today. It was like, oh,
Or
we
what their
need,
needs were.
yeah,
Yeah,
exactly. And so it's
yeah,
like we don't want to be blind to that of just no, we're gonna white knuckle this thing through everything. It's talking about it, kind of just take some time to kind of really think through what I'm hearing and feeling. How does that interact with my plan and my needs and making sure those are lining up year after year.
yeah. Well, and having somebody, like you said, to help you keep your eye on the ball when there's
Hmm.
always a reason to get distracted.
Yeah.
You and I were looking at this list. I'm gonna go back to a slide that was all the reasons not to invest. So this is from J.P. Morgan's private banking group, and they is that showing up there?
Yep. Yep.
Going back 24 years, all the reasons and events that were problematic.
Yeah.
The number on the right is a portfolio that they keep track of global stocks, and just how every year there's something that is, the headlines are gonna throw stuff at you to scare you, and that doesn't mean that they're never that's all inconsequential, but if you stay with a like just looking at today approach, you're always gonna miss the ball.
Hmm.
You're never gonna be able to predict what's gonna happen this week.
Right. Yeah.
Um, well, and one of the slides I have kind of puts it in like a cyclical format. And so, we start out with a period of like uh, things are looking optimistic and start to feel better, but then eventually things get carried away, start to get on a rocky path, and then it slides into a market. Basically, panic is too strong in most cycles, but um, this general sentiment about how people feel, where would you guess? Where do you feel like things are today for most people? I know it's different for everybody.
Well, I would think, I would hope optimism, but maybe that's just,
I
uh,
think we're further than that because I think, if you remember in 2022 was a bad year where almost everything was down,
yeah,
even down double digits. And, so from a mini cycle standpoint, 2023 felt like it was more of the, starting to have that optimism
optimism,
again. And
excitement.
now being
Yeah,
more into this space where when you look at some of the stocks that are hitting these like crazy heights, I, I'm not predicting that, um, Tesla or Nvidia or anything are gonna like drop like a rock. That's not what I mean. It just seems like when I don't a lot of when you hear people talk about it, it's not like rooted in analysis and like numbers. It's very emotional.
yeah,
And so remembering that though, that there is a swinging cycle helps you stay the course to say, okay, because in a moment we're going to talk about like what's some practical things in 2025 that you can do and think about for your investments. But this is important to remember that there are going to be these cycles and swings that are often, connected to those headlines. Keeping that in mind is what helps you be a better long-term investor.
yeah.
Um, any other questions? We should mention that you can
Yes, yeah, yeah.
send
In
a
the Q and
question.
A at the bottom, yeah, feel free to chime in with questions as they come up, or if you want to save them for the end, you can do that too. Anything works. But yeah, this is a open discussion, and love to hear from you guys on the call.
One other thing I wanted to talk about with 2025 and one of the challenges is this idea of like highly speculative assets.
Mm,
And we're getting ready for the Super Bowl, and sports betting is really big right
yes,
now. And there is an aspect, in fact, we were looking at this headline in the Wall Street Journal a few weeks ago about particularly men. Investing can be highly addictive because
yes,
it can be seen as a game, and it's something that you got to win and that uh, you're trying to beat others with, I guess, and how dangerous that can be. And you feel like you've seen that more in the last 12
yeah,
months?
yeah. Last 12 months for sure, but it also just within the last 4 to 5 years, you kind of catch the meme stock at in
Yeah.
COVID, and it's like, oh, it's like, and it that kind of had this feeling of like little guy beating the big guy with GameStop and some of those others. And that kind of caught steam, and that's died off. And then you got Bitcoin rearing its head, then it's down a little bit. Now it's rearing its head again, and so it's all these kind of momentum plays that people are like, oh, fear, FOMO, fear of missing out, rears its head in different areas of the market, and so we see that for sure. And I think too, it's also been maybe easily accessible with some of these apps, and like, oh, free
Yeah.
trades, and it's like it's not as it's more accessible, and therefore I just hit a button and I can see my account value. Oh, it went down
Yeah.
thousands of dollars today. It went up thousands of dollars today. You get that instant either dopamine hit or whatever to fuel those emotions that you're
Right.
experiencing.
Yeah, it's like the that investor swing cycle and
Yeah.
a much higher and lower,
Yes.
faster swings. And you see that I think with Bitcoin,
Mm-hmm.
similar thing. If you ask most people who invest in Bitcoin, like to tell them about it, what's the point? Go into the analysis of the investment. They can't. They can't. It was just like I don't know. I heard about it,
Yeah.
and it's doing it. It did well, so I'm gonna throw money at it. That's not really investing.
Right.
That's speculating.
Yeah.
And I think the last thing before I kind of jump into the 2025 principles that I want to talk through is understanding like the different types of investing there are. There's three different types of investors, and that's fits with what we're looking at right now. And these three different types are from Benjamin Graham did a famous book or early in the 20th century that really influenced Warren Buffett called The Intelligent Investor, and he talked about these three different types of investors. And the one that we were just talking about, and that the article references on the screen, is just what's called the speculator. Someone who's speculating is just buying something, hoping it's going to go up tomorrow.
Right.
And you can speculate with anything. And speculating I deem is not really true investing in most instances. I like this visual from Behavior Gap, where it's speculating is looking at short-term wild swings, where true investing is looking at, okay, where is something going to be 10 years from now?
Mm-hmm.
Like nobody buys a house planning on selling it next week. Uh, if you're flipping a house, you might plan on flipping it, next quarter. But there's specific things you're doing to improve it in the meantime. Speculating is just buying, hoping that it goes up next week, next month, however long. But it's just it's basically gambling.
Yeah.
And that's a really dangerous way, I think, for people to invest.
Yeah, I know there's a group, Gamblers Anonymous, and they've been seeing a rise in. Okay, yes, there's the sports betting that's always kind of there, the sports and casinos or whatever, but the rise in people going to those groups because of their trading
Yeah,
tendencies in apps like Robinhood or wherever. But it's like, hey, listen, yeah, I was day trading, or I was trading options, or I got into Bitcoin, and it's like
yeah,
you have a couple early wins and it feels good, and you feel like, hey, I might be really good at this, and maybe you ride that wave for a little bit, but you can easily get burned when you're speculating,
yeah.
right? And so we want to
I've met a lot of people who do day trading or who have invested in Bitcoin and things like that. How many clients have you personally worked with, clients or people you've met that made it big day trading, like actually became rich?
zero.
Yeah, my
Yeah.
entire career, I've met a lot of people who do it.
Yes.
Never met anybody who, now I have met somebody who got rich off of day trading, but that was because they sold curriculum for day trading.
Uh,
They sold it to other people. They didn't actually, they didn't
right.
get rich from doing the trading.
Yeah.
So it's speculating. You're just trying to predict too much, like what is going to happen in the future. It's too
Yeah.
risky. So that's not true investing. The second kind of investing that Benjamin Graham talks about is called the enterprising investor.
Okay.
And this is somebody who sees an opportunity, who sees a possibility, and then like it meets that opportunity. So we talked about like flipping a house. Somebody sees a house that has a lot of possibility, but right now isn't in that current state. They buy it, fix it up, turn it around, and sell it for a greater value. That's the type of investing. And in that type, they can create a ton of wealth. That could be, starting a business. It can be, analyzing a stock that you think is going to do really, really well. But with an enterprising investor, at least in my experience, those that do it really well are able to do it because they have some unfair advantage. Like they know something, that other people don't know, or they know people that other people don't know, or have a skill that surpasses everybody else's. Like the house flipper, like I
Yeah.
can't flip a house because I don't have, I would have to hire people to do all that work, and that would eat into my profits.
Hmm.
And so in that sense, people who can do it themselves, like are really good house flippers or are realtors and can find the good deals that aren't even on the market yet,
Yeah.
or have a lot of connections that they're able to leverage. Those make really good enterprising investors.
Hmm.
And it creates a lot of wealth, but it also is usually concentrated.
Yes. Yeah, you're not super diversified when you're in that bucket.
Right.
Yeah.
So, like, for getting personal, for me personally, like my enterprising investment is I bought shares, I bought ownership in Sound Stewardship because
Hmm.
I am a financial planner. So I wanted to own part of a financial planning firm.
Hmm.
And that's a way and it is something that I can help make successful. I can't make the S&P 500 go up or down this year, but I can do something with my efforts to like improve sound stewardship and serve clients better. And so that's a type of enterprising investment.
Yeah.
Um, Sometimes I run into people who try to use big stocks and analyze the stocks and research the stocks, and do enterprising investing that way and pick their own stocks. And it can work. The
Yeah.
challenge is back to that unfair advantage. When you're trying to figure out what are the stocks to buy this year, what information, public information, not
Yeah.
non-public information, but what information or what unfair relationships, skills, what things can you see that the rest of the market can't see? Um, I don't know how to answer that when I'm looking at stock like Microsoft or Apple or Nvidia. Like I don't know those companies better than, all the analysts that are
Hmm.
covering them that have, all these designations. And most of the time they don't seem to get it right when they say, what they think it's going to do over the next year. So enterprising investor, it seems like it's really hard to do that with
Yeah.
some of these big public companies.
Yeah. Yeah. And the time commitment,
Yeah.
it's a big factor of like, okay, you're going to spend all your time leaning into this, like, and then reflecting back, was it worth my time? Was it worth
Yeah.
the 6 hour research project to do the stock buy or whatever? I don't know, but it's like that's one thing is like you could feels like you have control, but at the end of the day, if you end up at the same point as someone who was just diversified and bought a wide range of stocks that were plugged into the market, domestic, international,
Yeah.
and you got to the same point, it's like, well, why would you do that?
Right.
That doesn't make sense. So
Yeah. Well, and so that takes me to that third type of investor. If it was, speculator, which is just gambling, in my opinion, enterprising investor, and then the third one is Benjamin Graham called it a defensive investor, but it's somebody who is trying to preserve wealth more than create wealth. So you can create wealth by concentrating resources, putting all your chips in one basket, but you just have a lot more risk.
yeah.
A defensive investor is diversifying, and obviously you're investing because you want the money to grow, like
Hmm.
you want it to hit reasonable returns, but by diversifying, you're preserving the wealth, not, so it might not double overnight, but it's also not going to disappear overnight in the same way that if you have all your eggs in one basket,
Hmm.
something could happen.
Yeah.
So the vast majority of the portfolios that we work with, as that you and I work with clients, they're really in that more defensive approach. They've saved in their 401k their entire lives, and our mandate is to make sure that 401k is there when they need it, whether they're retiring this year or when they need it because they need a withdrawal in their 90th year. It needs to be there, and obviously they want it to grow, but it has to grow in a way that is going to like keep it defensively.
Yeah.
So the principles of defensive investing are very different, and that's kind of how I want to end here.
Yeah. Yeah, that'd be good. So leading into 2025, making sure our the way we're thinking about investing lines up with principles. I think that's what that's what we, as a firm, we always like
Yeah.
to fall back on our principles there. That way we know no matter what the noise is, the principles are true through any kind of market cycle, headline, life event. Like we want to honor these principles there. So I'd love to hear what you
Yeah.
have.
All right. Four principles, and I'm done. Number one is think long term.
Okay.
I don't know. How often do you think in a week a client says, "Hey, what do you think's going on with the market this year?"
Right. Probably at least a handful of times throughout the week. Maybe every meeting or every other meeting.
Yeah. But like I have no idea what's going to happen in the next, 12 days, 12 weeks, 12 months. And even though I don't have any idea what's going to happen in the next 12 years, uh, ironically, the bigger the time period that you're looking at, the easier it is to kind of predict, not necessarily what returns are going to be 12 years from now, but like the patterns are a little easier to see in most instances. So like for instance, you might be able to say based on, market valuations or whatever today, the average returns over a 10-year period are, X. And a lot of times the variance there is actually pretty close. Um, but the path, so if you say, okay, those return expectations are, 5%, like you can a lot of look at those long-term predictions, and they're actually not that far off in a lot of cases. But the path, so if it was five, the path to get there might have been crazy. It might have been,
Yes.
it might have not, it might have been slow and steady. Um, but it actually, if you think long term, the analogy I would use is like the real estate market. Most people know if you're going to hold a property anywhere for a period of 10 to 15 years, you're most likely not going to lose money over a long period like that. Like obviously you could get into some spaces where you bought really high and this and a development didn't go that
Yeah.
direction or whatever. But if you're buying a home, most instances over 10 to 15 years, it's going to go up. But with like the 08, 09 housing crisis, there might be periods of time where there certainly is difficulty and challenge. And if you are thinking short term, and if you have to sell your house in that year, then you're in a challenge. But if you're able to just wait it out, then you don't have a real estate issue.
Yep.
Same thing with investing. Trying to time the market and figure out, looking at that quilt and trying to figure out, okay, oh, gold did high last year, so maybe I should buy gold this year. Like that to me seems like a recipe for disaster
Hmm.
rather than thinking long term. So that's my first thing.
Good.
Which goes all the way back to your question of why not just buy the S&P 500? Because if you think long term enough, there are many periods where international or particularly small companies outperformed the S&P 500 just in the last 10 to 15 years. That's not where the cycle's been, but thinking that's going to go on forever, that's not long-term thinking.
Right. Yeah, I know a lot of the forward projections uh, make small caps and international look very attractive compared to their large company counterparts there, and so it's like these things are cyclical. And remember, like what's the no-brainer trade today was not the same thing 10 years ago for the no-brainer trade and 20
Right.
years ago, and so just keep that in mind as you're doing the no-brainer trade for
Yeah.
2025.
So that brings me to the second thing, which is prepare, but not predict.
Okay.
So, like, you shouldn't be surprised when the market surprises you, that because of that cyclical nature. I don't know, when the next downturn is going to be, if there's going to be a market drop, in 2025, or if it won't be until 2030. But I had somebody ask, like, hey, do you think the market is gonna have a bad year? I was like, oh yeah, absolutely. And they
Yeah.
said, really? I said, yeah, I don't know if it's this year or,
Right.
they just retired
Yeah.
this year or, but sometime in your retirement, Lord willing, you live a long time, like the market is just like it has had bad years, pretty consistently, but not predictably.
Yeah.
So we don't try to predict what's going to happen, but we do try to prepare so that we say, okay, if your portfolio is prepared, then if the market is a really good year, you should experience that. Like that asset quilt, you're not gonna hit the highs of the highest things or the lows of the lowest things, but you should have a good year. That's being prepared. And then being prepared is also, okay, what if the market has a really bad year, like it did in 2022? Like, well, you should have a plan for what happens.
Hmm.
Like you should know ahead of time, like, okay, the market could have a bad year, so what will I do?
Yep.
And what that looks like is different for each investor.
Hmm.
But if somebody, for instance, is getting ready to retire, and let's say they're retiring in 2025, and they know they're going to need their pot of resources to live off in 2025, then there should be at least part of those resources that are already ready to go. And, if the market had a big downturn, um, it would be too late to activate that. They didn't make hay while the sun was shining.
Right.
And so like you need to have some in the barn already. And so preparing without predicting, because I don't know what it's going to do, but positioning yourself so that regardless of whether it's good, bad, or neutral, you're already ready. That's our best way to handle it.
Yeah. Yeah, I like that too because it incorporates the investments, but also looking outside of just the 401k, IRA, Roth IRA, and looking at the whole picture. That's the type of planning we like to do, and saying, okay, well, this supplements my life in this area, but what other things do I need to make sure I have aligned with that to
Yeah,
fulfill my plan? And
yeah,
cash, debt management. Those are all part of this puzzle too to prepare you for whatever market fluctuations, headlines. It's not just in the account.
right.
Yeah.
Yeah, and being able to handle that, it might be way more important what's in that emergency fund
Hmm.
or like you said, having the debt paid off than what's happening in the portfolio. Because a lot of
Right.
times you just have to leave the portfolio alone,
Yeah.
and but having those other items dealt with are going to have a much bigger impact in your own personal life.
Hmm. Yep.
Um, okay, so think long term, prepare, don't predict. And then the third one is stay diversified. And particularly here, so that's going back to that quilt. Now, the quilt, again, it's not an investment recommendation. We're not saying client portfolios do not have everything in that asset quilt, our client portfolios. It's just an example of different types of assets,
Hmm.
but your assets should be diversified to help you get through all that, whatever you're trying to prepare for. And then using the nerdy magic of periodic rebalancing
Yes.
to stay disciplined in that diversification.
Yep.
Because what rebalancing does is like, well, here, let me go back to that. Let me go back to that quilt. Um,
Yeah.
uh,
Last year was a good example
yeah.
for some periodic rebalancing opportunities.
So in rebalancing last year, what was looking at the quilt? What do most of those moves look like for people? Like what would have been a rebalance, in this type of chart, just to practically use it here.
Yeah, and so you'd look at selling maybe some gold to buy low or to buy, make sure the portfolio is balanced with maybe bonds or on international equities.
Yeah.
Um, and so it's just things that are performing well. Are those in line with the target? If they're a little bit above the target, let's take some of the cream from the top there and plug it into something that's not performing well, knowing that we still want the low performer. That's still part of the mix. It's not like,
Right.
and there are times where you review the portfolio and like, no, this particular fund is no longer serving my plan and I need to replace it with something. So you got to think through that
Sure.
too. But these asset classes, I'd argue that, a lot of these need to stay on the board for most people. And so it's just kind of being strategic about, okay, gold was up this year. Let's sell some of
Yeah.
that and buy into lower areas and then
Yeah.
see.
And I'm going to throw out some numbers. These aren't recommendations. It's just illustration. But if like you wanted gold and you mentioned like international stock down here in the blue, if you wanted both of those to have, 5% of your portfolio and, gold was up to 7% and international was down to 3%, like what rebalancing does is it doesn't zap the gold, but it says, okay, I'm gonna, cut off a little bit of that and use the proceeds to buy more of this. And it can feel a little gut wrenching when you're selling a winner
Yeah.
doing what feels like buying a loser. But the concept there is that's what helps you stay disciplined and sell high and buy low, which that's I mean that's what investing is all about.
Right.
Selling high and buying low, and rebalancing helps you do that.
Yeah.
Um, So the diversification, that's the third thing. And then the last thing I had is just staying disciplined and just sticking with it and not letting the emotions of all those headlines lead to the decision making, but having a well thought out, even written plan and sticking with it
Yeah.
regularly. And that's where I think, like you talked about, it's super helpful to have someone else that you share your plan with, or like in our case, a professional advisor who's helping you create a plan and then stick with it.
Yeah.
Um, but having it written down then lets you revisit it to say, okay, well, when did you change? When are you going to, um, you know, if you're buying XYZ, like when are you going to sell it? I want one of the joys of being a financial planner is, you know, when you meet strangers, they like to tell you random things about their financial life. Have you had that happen, Derek?
Yes. Yes.
And I sat next to a guy in the plane once. He found out what I did, and he like started pulling up his accounts, and he had bought some, I don't remember what, some pharmaceutical stock that had gone up to like $1 million in his account, and he just couldn't like wait to show me this. And I was like, "Oh, that's interesting. When are you going to sell?" It's like, "What do you mean?" I'm like, "Well, like that stock goes up and down all the time. Like at some point, if you want to use that money, like and lock that in, you got to sell. Like when are you going to sell?" He's like, "Oh, I'm never going to sell. I never want to sell." And that you need to have a plan that says, okay, when is the exit plan?
Yeah.
Um, and staying disciplined, writing it down, helps you avoid some of the emotions of the moment.
Yes. Yes, very much so. Having the plan, and then also I'd say, leaning into things to help you achieve that plan. So what I mean by that is, do we automate investing? Is that through 401k, or is it through a monthly contribution to an account? Kind of set it there.
Yeah.
Not every we're reviewing things. We'd like to review periodically, but we're not adjusting things all the time. It's kind of setting that automatic investing there. Other things of, okay, well, maybe you do have a stock like that pharmaceutical that has gone way up. Well, there's certain type of trade orders that you can put in place to, hey, I know I don't want it to go, I don't want to lose 30% of what I've gained. Okay, you could use the software, the tech to help you accomplish that versus you having to watch the headline or check in with the stock every day and like, okay, is it there? And it
Right.
allows you to be less emotional around that decision because you've already said, okay, if it gets to this point, here's what I'm going to do, and I've told the software do that for me, and so it'll take care of it for you, and then that can be helpful there.
Yeah.
And so it's just knowing what the plan is and what tools you need to familiarize yourself with to accomplish your plan there.
Yeah.
But there's a lot of things that help.
Well, that's what I have for today. I know there's so much stuff talked about in the investment space, and most of it, honestly, is garbage. So hopefully this was not garbage. But any questions or anything else, Derek, you want to hit on?
Yeah, I think one thing for investing, and we've seen a rise in this over. I mean, we've been at Sound Stewardship almost 10 years. It'll be 10 years this year, but the values based investing and how that's really come online for 20 in previous years, but also that will grow more, and so that's another thing to kind of look at of in your plan of yes, we're diversified, but okay, what's all in that mix, and
Right.
how do I feel about that? That's another question to ask yourself. Am I diversified? What's my plan? Who's going to help me? What are the tools I need? But am I okay with what I'm owning?
Yeah.
And
Yeah, because
so
back to that chart that had all those boxes, of all the companies you own, there might be companies that do things that you disagree with fundamentally, the type of business they're in.
mhm.
Um, talk to clients who lost family members to lung cancer from smoking their whole lives, and they said,
Yeah,
"I want to own, big
right.
tobacco."
Yeah.
or clients who say, I don't want to have anything to do with adult entertainment, or abortifacients, or big oil, or whatever it is
Yeah.
your value, the values-based investing says, okay, well then how do we build a portfolio that excludes those things that you don't want to participate in, but then also leans into the things that you want to encourage and embrace as an owner. You're an owner in those companies. How do you lean into it?
Hmm.
And then for the gray areas in between, where it's like, well, the company's not, doing stuff that's antithetical to your views, but maybe the way they run their company you don't like. How do you use your influence as an owner?
Hmm.
That's something that values-based investing is doing,
Hmm.
and is a huge topic right now, like you said.
Yeah. Yeah. Good. Well, Jonathan, thank you again for taking some time out of your day to talk with us about the principles around investing and how we should be thinking about investing, not just in 2025, but the long term. And so I know I have my homework of reviewing my plan, rebalancing my accounts there. And so that's always good reminders there.
Or
And
just have your advisor do it, Dave.
that's right. That's right. That's right. And so, but yeah, we appreciate you take some time out today.
Thank you.
Thank you guys for joining the call here. We'll have that recording posted for too long, and then we hope to see you guys in February for our next webinar there. So stay tuned for that. Take care.
Bye.
Bye.